giving you the content. I just want to help you really master this skill. How do you solve GST problem to start with? Okay, you may want to write this down. Never ever write or never ever answer any GST questions, whether it's sitting for exam or in the real world, by using what you know already in income tax principles. Because GST and income tax are two separate branches of the tax law. A lot of people actually know GST by using what they already know in income tax to solve the problem. Well, I meet with so many practitioners in the real world who are finance professionals, and they are stuck with this. So if you cannot remember what I'm going to give you in this presentation, at least the principle never solve any GST issues using income tax principle is something you have to bear in mind. Okay, so without further ado, let's deep dive into the content of what is going to be covered in this session. Okay, so I'm going to give you the slides. So as I'm going through the slides, I'm also using some interactive drawing using my Apple Pencil. So you may even want to take out a piece of paper and follow me. When I'm drawing something, you may want to follow me and learn together. Okay, so the topic again is understanding of the scope of Singapore GST, and what is going to be covered in this presentation are as follows. Number one, I'm going to repeat, to some of you might be a repeat, what is Singapore GST, by the way, and then we will talk about the scope of GST. Now, one of the things that I want to specify or I want to emphasize in this presentation is the concept of out-of-scope transactions or out-of-scope supply. What exactly it is and how is it, why is it important to be understood from a Singapore GST perspective? We'll talk about third country sales, a concept that might be alien to you because this is a sale by third parties outside of Singapore, and how is that kind of sales impact on Singapore GST. Okay, we will talk about transfer of going concern, what exactly it is, and how is that applied in the real world application. I will end with this presentation with a couple of case studies to showcase, well, based on the concept that I'm going to cover in this presentation, how you can help yourself identify and potentially solve the issues from a GST perspective. And then I'll wrap up the presentation by going through the summary and the key lessons in this presentation. Okay, does it sound good? If it does, then let's begin. Okay, so what we are going to talk about is the understanding of the fundamentals of Singapore GST. And then we'll talk about what are the in-scope or within the scope supply from a GST perspective. And like I said, we'll talk about what is out-of-scope supply, what is third-party sales, and what is transfer of going concern. And then we'll summarize the case studies. Okay, using case studies approach to summarize some of the key lessons from this presentation. Now let's talk about the introduction of GST. So I'm not going to repeat a lot from what you already know from reading your material. So number one, let's talk about the GST scope. So GST, as you may know, it was introduced in Singapore on the 1st of April 1994. So at the time of recording, it has already got a 30 years experience, 30 years history, and it has been with us for a very long time. I don't know which year you were born. It has been in Singapore for a very long time. So what is GST, by the way? Now, GST is actually a consumption tax. If you understand the principle of consumption tax, whereas income tax is a tax on income, GST is actually applied to literally local consumptions of goods and services. So unless you do not eat, you don't drink, okay, which human beings, all of us, we can't do, well, we are subject to the GST framework. So currently at the time of the recording, it is 9% GST. So I started off from my first year of GST practice with 3. And then if you follow through the history, 3%, 4%, 5%, 7%, 8%, and 9%. So right now, GST rate is 9%. Okay, so what is this? Why is GST important to our Singapore economy? You may ask. Well, let's face it. The key concept of GST, as I've already alluded earlier on, is about what we call consumption tax. Like I said, unless you do not eat, you do not drink, okay, you are subject to the GST framework. Now, if you have a look of how, what is the significance, what is the contribution of the GST revenue from a tax collection perspective, if you look at the IRA's annual report, as of now, the latest one being FY 2022/23, GST is actually about 21% of the total tax revenue collected by IRA's. I mean, this is from the annual report last year, and it is quite significant. Of course, as compared to the income tax contribution, revenue contribution, which was 51% in total from corporate and personal income tax, where GST is quite significant. In fact, if you look at GST, personal income tax, and corporate income tax, the collection together from these three streams of tax revenue is almost 3/4 of the total tax revenue collected by IRAS. And GST is meant to provide what we call a equity or fairness concept. So what do I mean by that? It is actually applied to everyone, right? And you can say that it is fair from that perspective. Like, it's not about like because you are financially capable, like income tax you pay more, and if you belong to a low income group you pay less. GST on the other hand is applied to everybody. So the more you consume, the more you pay. That's how it works. And it is considered efficient because here in Singapore, the GST system is a self-assessment system. Now you think about it. IRAS will only ask the GST registered persons to file their tax return every quarter. I mean, it's the general rule. And they will not really audit or investigate unless something crops up. So it means that they trust what the taxpayers or taxable persons have filed unless something goes wrong. And as a result, only they can spend a lot of time. You think about it, the IRAS officers can spend a lot of time and resources to look at those black sheep in the marketplace. Okay, you think about it. So it is pretty efficient in terms of tax collection, tax revenue collection for GST, and this is how it works. Now, let's talk about the GST system in Singapore. So the GST system in Singapore is from the UK value-added system back in, if I'm not wrong, 1983, and also is heavily modeled the New Zealand system. Now you take a look of, if you have a chance to do research of the world's GST, VAT or indirect tax system, you may notice that there are more than 140. That was what I was told last time, and based on my current research, it has like almost 160 countries in the world which has some form of GST and VAT system. Now, you may think that, hey, US, United States, have a sales tax system. In Malaysia, there is a sales tax and a sales and services tax SST system. And some other countries may have their own VAT system. So our system comes from a few perspectives, which you may want to take note. Number one, our system is different from the EU system, the Malaysian system, to a certain extent, Indian system, even Canada system. Okay, so when you are doing some research work, bear in mind it's very important not to go to other VAT system or GST system to do research because the rules might be different. Our rules are founded based on a couple of principles, so you may want to write this down. Number one, in Singapore GST framework, we got only certain rates. So GST right now is 9%, which is called a standard rate. And then if let's suppose you have a supply that is 0 rated, so therefore the GST is at 0%. And if this is the out of scope supply, or it is an excluded supply, which I'm going to talk about transfer of going concern later, and the GST for that would be not applicable. So in Singapore, There are only three rates. If you take into account not applicable as one of them, there are only three rates. If you go to buy a packet of rice from NTUC, Fair Price, or from Giant, you cannot say this is basic necessity. And as a result, you still have to pay the 9%, right? You cannot tell the government, but that's not fair or what, because we apply the GST system as a broad base. It's either 9% or 0%, or it is not applicable. There's no such other rates like UK. You have something called standard rate of supply, which is 20%. And then there's a reduced rate supply of 5%. We don't have that in Singapore system. Okay? And on the other hand, the other things about the GST system is, hey, in Singapore, you would notice that we talk about something called a GST registered person. So once you are GST registered, you will have to comply with the GST filing obligations or reporting obligations once you are GST registered. And how do I know if I'm GST registered? Now in Singapore, our concept is very simple. We have got a revenue threshold or we call annual value, okay, annual value of taxable supply. Okay, ours is pretty much quite high. We call it is actually 1 million Sing dollars. You may think 1 million is not a lot, but truth be told, you look at other country system, the registration threshold is actually lower than what we have in Singapore. Ours is 1 million. What does it mean? It means that it is more difficult to be under the GST scope compared with the same kind of business that may happen or that may be carried out in other countries. Okay, our system falls upon the concept called, because it is local consumption, is a local consumption. It means that, let me just cross this out, I will write again. So ours is based on local consumption. So let's say this is a very simple map. And we draw a line here that signals the border of Singapore, which is below, and places that are not in Singapore, we call outside Singapore. So what GST in Singapore means is that if the local consumption, which means the consumption takes place in Singapore, then there is a taxable supply. Okay, there's a taxable supply. And then if the consumption takes place outside Singapore, then this is what we call a not Singapore or non-Singapore supply, or non-Singapore supply for GST purposes. By right, there shouldn't be any GST implication, which is the reason why do we talk about international service and export of goods, which might potentially be subject to zero rating, is because you think about it, when the goods are exported out of Singapore, logically, the consumption would take place outside of Singapore. And therefore, by right, there shouldn't be any Singapore GST to be imposed for such export of goods. Similarly, for international service, because the consumption of the services takes place outside Singapore. So again, by right, there shouldn't be any GST involved from a Singapore GST perspective. So what I'm talking about, this is a principle that I teach in other classes. It's called the destination principle. So destination principle says that the GST implication for Singapore will only happen where the consumptions of goods and services takes place in Singapore. So on the flip side, if the consumption of goods and services does not take place in Singapore, then GST from Singapore perspective shouldn't apply. Okay, so this is our principle. This is our principle in Singapore GST. So keep that in mind. Okay, and then let's talk about some examples here. So let's talk about this example. So here is a case study. As you can see, Techno Gadgets Private Limited. Okay, so Techno Gadgets is a retailer of consumer electronics in Singapore. And it has recently expanded its product range and expects increased customer traffic. The management is evaluating its tax responsibilities under the GST framework. Now, let's suppose Techno Gadgets has already registered for Singapore GST. So what would be the GST implication if it were to introduce new products? And what will be the impact on the overall revenue? Okay? So you may tell that, okay, if Techno Gadgets is already GST registered, okay, GST registered, then any supply of new products would be subject to 9%, which is the standard rate, if the supply is a taxable supply, unless the products are exported out of Singapore. Most importantly, if the export fulfills what we call the export documentation requirement. So if you can fulfill the export plus what we call the export documentation requirement, I call it EDR, once again, export documentation requirement, then you can zero rate the supply. Okay? So why is that important? It's because from a reporting perspective, if it is a standard rated supply, I've got to report standard rated supply in the right box in my GST return. And if this falls under the zero rated supply, then guess what? Obviously, I need to report the total value of zero rated supply in the right box of the GST return. Okay? And then if let's say I am introducing new product, like Techno Gadget said, I'm introducing new product. I have to understand, okay, if I were to charge 9%, because the law says I have to charge the 9%, do I want to absorb it? Or do I want to pass on the 9% to the customer? Now, some customer who are new to you might complain, isn't it true? Might complain about, hey, why am I suffering from additional 9% charge? Because they may query you, and you would have to say that, well, it's actually not because of I wanted to charge you 9%, it's because as a matter of the law, I'm required to charge you a 9%. So therefore, Techno Gadgets will have to pass on the 9% to the customer. Then let's think about it. The customer may also be GST registered. So if the customer is a GST registered person, then the concept is when Techno Gadgets charges the 9%, that is actually the output tax. Output tax, the tax that I charge as a supplier to my consumer. And then the question is that whether the consumer is able to claim it back as an input tax, which other videos, I hope the trainers will talk about this, not in this video, but the fact is that then there's a question of whether the customers can claim it back as an input tax credit from IRAS. And then input tax credit is actually dollar for dollar. It's not like a tax, it's not a tax deduction for income tax. It's actually a dollar for dollar credit given by IRAS. And of course, there are certain sets of rules that the consumers here must fulfill in order to claim it back as an input tax credit from IRAS. Okay, so it means that it is pretty important to know, as Techno Gadgets, a GST registered person, I have to make sure that I'm actually charging the right amount of GST to my customers, if it is required to be charged as a standard rate of supply, or if it is an export of goods subject to the satisfaction of export documentation requirement, I may then charge 0%, which is zero rate of supply, to my consumers overseas. So it is pretty important to understand that. Okay? And then the next thing to take note of is, what is the Singapore's approach compared to other countries? So just now when we say that, let me just remove some of these things because it becomes messy. Okay, so this is just a bit of what you see in the real world. That is, if this is an export of goods for Singapore GST perspective, what does it mean to the other country? When the customer is located in another country, therefore, it becomes the import of the goods in the other country. The question is whether there is a GST or VAT system that exists in the other country, because Singapore's export becomes import of goods from another country's perspective. So then the other country's GST or VAT law may apply in this case. And why am I talking about this in this part? It is because who knows that this customer could well be a subsidiary or related party of Techno Gadgets in the other country. And therefore, this related party transaction may not have any impact dollar for dollar for GST perspective, from a GST perspective in Singapore. But it has a VAT or GST implication arising from the import in another country. So if you are the group tax director or if you are the vice president of the tax of the group, while you may not need to so worry about the Singapore GST, you may still have to focus on what's happening from a GST or VAT perspective in the other country. So this is something you need to take note of. Okay, so enough said, let's move on to the next topic. What is scope of the Singapore GST? Now, Singapore's scope of GST, number one, as I said many times, so far, it is applied to goods and services in Singapore. So a local consumption of goods and services in Singapore. So you may have heard of this concept, goods versus services. So you've got to know if you in a particular supply, what is considered goods, what is considered services. And know in the real world, what happens is that it's very easy for somebody who has accounting background to be able to tell you what is goods and what is service. For example, the accountants love to say, you know what, goods are something you can see, you can feel, and you can touch because of the word tangibility. Goods are tangible. Whereas for services, well, it's something that I can feel. I can't see physically because the service is not physically visible, but I can feel it. So this is intangibles, so to speak. So accountants love to use the concept of tangible versus intangible to describe why something is, well, a supply is a supply of goods, whereas the other supply is a supply of service. So a couple of principles to take note in Singapore. Number one, under Section 10, Subsection 2 of the GST Act. Now, at times, I may throw a few sections. I'm not asking you to go to the sections to read and memorize it, but just giving you the sources of information so that you know this is not what you were told by another practitioner. Because whatever I said is actually based on the GST Act. So in GST Act, the Section 10, Subsection 2 actually has two paragraphs, and one of the paragraphs says that if it is not a supply of goods, it is a supply of services. So this is an important principle to remember. And then the other concept is that why is the distinction between goods and services are so important? Well, under Section 13, okay, of the GST Act, which is the place of supply, okay, place of supply rule, the place of supply rule for goods and place of supply of services are completely different. Okay, so in order to avoid applying the wrong rules for place of supply, you got to know whether the supply itself is a supply of goods versus supply of services. And how do I make the distinction? Well, the key point is not about whether it's tangible or intangible. The funny thing is that you can actually go to the IRAS website and to find out some very interesting IRAS examples. And you may wonder, what exactly the mindset of IRAS when they talk about this supply is a supply of goods and this is a supply of services. So for the purpose of going through the rules, the first thing is not about how you feel or what IRAS says, because IRAS will never give you the rules. Because the funny thing is that goods and services are not defined in the GST Act. So you may want to look at second schedule of the GST Act, because this is actually a very commonly overlooked area, because the second schedule of the GST Act actually suggests Some supplies are deemed to be supply of goods. Some supply are deemed to be supply of services, and it's prescribed in the second schedule. So the first thing before you exercise your gut, your intuition, your feeling, you need to go to the second schedule first to see whether there's already prescribed rule to define certain supply as being goods versus services. Only if the second schedule does not give you the answer, then you're welcome to look at IRA's examples or case law from the UK and New Zealand. At the beginning of this presentation, I said our law pretty much is founded based on the UK VAT Act, and is also heavily modeling the New Zealand GST provisions. So this is the reason why in researching case law, for example, we lean towards the UK and the New Zealand cases. Okay, so I hope that helps. Let's move on to the next thing, the place of supply rule. What is the place of supply rule for GST services? So for example, if it is a supply of goods, so you may want to draw with me. So this is help you to understand, because when you read the materials, it's words, it's very hard to see. I was talking to one of my friends who is a very experienced GST practitioner from a CA firm in Singapore, and she said the same thing. In order to understand and apply GST rules, you actually want to draw this out, create a picture, because most people actually are visuals learner. So in other words, when you see the picture, it helps you to understand. So what do I mean by the place of supply rules for the goods? For example, you might say, hey, number one, I have a supply of goods, okay, situation. And then in order to understand supply of goods, I need to identify the two parties here. So we call parties a seller, or use a letter S to denote the seller. And then I have a buyer, which is B in this scenario. Okay, so once I identify the supply as being supply of goods, then what do I do? Then how to apply the place of supply rule? So this is actually one of the things I teach in other classes. You may want to jot this down as well. Let's say we have a seller and a buyer, both are from Singapore. When a supply takes place here, it means that the goods are shifted from the seller to the buyer. Okay. Now, most people might say, oh, this is a local supply. And as a result, it is a 9% standard rate supply. I don't fault you if that is your assumption. But the funny thing is that the place of supply rule for goods has nothing to do with the identity and the location of the sellers and the buyers. Okay? It could be a case whereby the sellers and buyers are from Singapore, but the goods are currently overseas, where the legal title actually passes from the seller to the buyer overseas. So it is possible as a result, because of the location where the goods are at, this is not a supply, standard rate supply, this is actually an out of scope supply according to OOS, because the goods are overseas when they are changing hands. Okay, so even though you have a Singapore supplier and Singapore buyer, the supply itself may well be an out of scope supply. So what is the importance of this discussion? Is because I need to know for supply of goods, the place or the location where the goods are changing hands. Changing hands, in other words, it means that where the legal title passes. If the legal title passes outside Singapore, then the supply is an out of scope supply. But if the legal title passes in Singapore, then the supply is actually a standard rate supply. So by the same token, I could have a buyer and a seller overseas, and you might say, oh, you know what, this is an overseas sales. But guess what? When you drill down to the facts of the case, the goods are actually already in Singapore somehow. So it might be the seller has a third-party warehouse operator where the goods are stored in the third-party warehouses in Singapore. And then the buyer got somebody to go to the warehouse and pick up the goods. and the legal title passes in the warehouse. It happens in real life, by the way. So although you may say, hey, the seller and buyers are overseas, guess what? It is actually a standard rated supply because the legal title to the goods passes in Singapore. Okay? And then we could have two other situations whereby the sellers is exporting the goods from Singapore to a buyer overseas. Okay? So you might say that this is export of goods. There's nothing wrong with that idea. But here's the thing about export. In Singapore, in order to qualify for zero rated supply, Section 21.6 and 21.7, actually if you study the wording of the legislation, the wording is that the controller has to be satisfied that the goods are indeed exported. And the funny thing in practice is that because of the phrase, the controller has to be satisfied. So the onus of proof that the goods are exported falls on the supplier. And therefore, IRAS has issued what we call an export guide, which they update quite regularly. So I highly recommend that you have a check of the export guide to find out exactly what are the requirements for the controller of GST to be satisfied that the goods are really exported. Okay? So I'm not going into very detail on this, but just a concept. Although you may say it's export of goods, because of the phrase, the controller has to be satisfied, which means that there is export documentation requirement. And guess what? In practice, I've seen clients, my clients, who actually did not follow through the export documentation requirement. When the matter was revealed to the IRAS officer actually said one thing and only one thing. I'm sorry, it is not zero rated, it has to be standard rated. It's what I tell my client is totally based on the checklist from the export guide. It's not forgiving, it's actually no second chance. It's either you meet the requirement and you apply 0%, or it is a case that you fail and therefore you have to pay the 9%, you have to top up the 9%. Okay, so this is how it works. The last part of the conversation is that you could have a supplier from overseas who is importing goods into Singapore. And then what happens is that in Singapore GST, other than local consumption of goods and services in Singapore, the scope of GST also includes what we call the import of goods in Singapore. So that means it is very important for us to know how the goods are imported. And whoever is the importer of the goods will be responsible for paying the GST to the Singapore customs. Okay? Unless the importer has an import permit because of certain special concessions or special schemes, or it might be subject to certain what we call temporary import relief, so to speak. But that being said, other things being equal, there is an import GST in Singapore where importation of goods happens. So you can see therefore place of supply rules are as such, can be applied as such. So if you are a bit confused, don't worry. If this is the first time hearing this, I highly recommend you rewind the video and just to rewatch and take notes, because this flip chart is very important for you to understand the place of supply rules for goods. Now I'm going to remove this, and then I'm going to quickly talk about the services because I've limited space here. Okay, so let's suppose we talk about services again. I will draw a line here and we talk about Singapore and then overseas. Okay, so for supply of services, POSS, place of supply for services, the two parties involved are the R and the P, which is the service recipient and the service provider. Okay, you can say supplier, same thing. So then let's suppose the service is provided from Singapore provider to a Singapore recipient. Then guess what? You may then say, hey, the services are supplied locally and therefore it is a 9%. Now this is a case where you arrive at the right answer but wrong conclusion. Because the income tax principle really merely discusses the source of service income. Like the general rule says that if the services are rendered in Singapore, the source of the service income would be in Singapore. That is an income tax principle. Remember at the beginning I said you do not apply income tax principles to solve a GST problem. Okay, so that means in this case, you've got to ask yourself, why is it 9% for Singapore GST perspective? And the only answer is because the provider belongs in Singapore. That's it. It's not because the services are rendered in Singapore. It's because the provider belongs in Singapore. And the phrase belongs in Singapore, you can actually take a look of section 15 of the GST Act, which spells out very detailed what the rules are. Now, this is a very big mistake for many practitioners or finance professionals in Singapore because they associate the understanding of the income tax principles to solve a GST problem. Okay, so this is a big thing I've seen over the last decade or so. Okay, so then another thing is that you could have a provider and a recipient, both are outside Singapore. So when the supply of service takes place this way, then what do we say? Again, you might arrive at the right answer with the wrong conclusion. You may say because the services are rendered outside Singapore, it's not subject to anything about GST. If you remember what I said earlier, it is not because the services are rendered outside Singapore. It's because the provider belongs outside Singapore, and that's it. Okay, it's the provider doesn't belong in Singapore. So funny, right? Right? So therefore, this is the answer. Yes, it is an off-scope supply because the supplier, the provider of the service, doesn't belong in Singapore. All right. Now, then we complete the discussion with the two legs here. Okay, so one is what we call export of services. Just now in the previous diagram, we talked about export of goods. This is export of services. Now, the GST provision actually has a particular section called section 21, subsection 3. And subsection 3 talks about international services. You can only zero rate the supply as an international service supply when the conditions are met under section 21, subsection 3. If not, it is automatically a standard rate supply. Why? Because the provider belongs in Singapore. Okay, so a lot of people thought that, oh, I'm providing a service to somebody outside Singapore, and you know what, it should be zero rated, blah, blah, blah. But remember the principle. The the service provider belongs in Singapore. So the starting point of the conversation is 9%. Only if you can satisfy the conditions under section 21.3, okay, you cannot zero rate the supply. And that's where a lot of people make the mistake. They think that the service recipients are overseas, therefore I can zero rate the supply. And then I would love to throw a questions to you from now on, even though if you decide to practice GST, you can ask whoever tell you the rule, who says that? Who says that? Because if it is from somebody, like we call it, a person who understands GST in the wrong way, passes the information to another person, which is also wrong, then when you receive the information from the last person you heard of or heard from, it's obviously wrong information. So I love to actually challenge all my participants the question, who says that? Does the law support what you hear? Okay, this is pretty important. Last but not least, now for the purpose of this presentation, I'm not going to deep dive into it. I can spend a whole video just to talk about this because this is called the import of services. Now, the import of services has a lot of implication over the last 4 years at the time of the recording, simply because we have got digital supply, we have got remote supply of service, we have got reverse charge, RC, we have got import of low value goods is not from supply of services, but from the supply of goods, there's low value goods. Okay, so because of all this, what we are saying is that import of services might have GST implications. because of the digital supply, remote supply of services, and reverse charge. Okay, but just take note, the GST rules for place of supply for services can be complicated because most people actually are still quite new to these provisions, although he has been with us for minimum 1 year to now, like for digital supply, he has been with us at the time of recording for more than 3 years. But guess what? There's still a lot of people who do not understand. So pay attention to these rules and the development of it, and then you'll be good. Okay, so for the purpose of this video, I will keep going. So the next thing about the scope of supply is the time of supply rules. Now the time of supply rules, one of the key things to take note of is the basic tax point. I'm sure the notes cover this, but it is very important for you to know that what constitutes the time of supply. I mean, you want to pay attention to this particular piece, which is called the trigger point is based on the early of two conditions. One is when payment is received. Okay, well, you could have received advance payment before you render the services or deliver the goods, and by this token, the basic taxation point has been triggered. Okay, it could also be the case where you issue an invoice. Now, this is where most people actually are not aware of. Like when you study the notes, it may not come to your attention. So I need to highlight to you that there's no such word called tax invoice being issued. It's just invoice. A commercial invoice or debit note is good enough to trigger the time of supply rule. Okay, so the time of supply rule, which we use the basic taxation point to decide when you need to report the transaction, is the earlier of 1, the payment is received, or 2, an invoice is issued. Not necessarily a tax invoice. Like I said, a commercial invoice or debit note is good enough for this. Okay, which a lot of people actually are not aware of. They thought that it has to be a tax invoice. And the funny thing is this, when you issue a commercial invoice as a GST registered person, do you find it funny? As a GST registered person, you issue a commercial invoice. While of course, there are certain rules in IRA's concession that says that you don't necessarily issue tax invoice in all situations. For example, it could be to a customers overseas where you can fall under the export provisions. Or it could be an international supply of service and hence it is zero rated. And on that note, you do not need to issue a tax invoice as such. But just think about it. If it is a supply of service that is standard rated supply, you issue a commercial invoice. Does that sound weird? Because later you still have to follow up with a tax invoice. Okay, so therefore the question is that whenever I'm hearing GST registered person who told me that they issue commercial invoice, I would just frown upon them and say, hey, why a commercial invoice? Since you will still have to issue a tax invoice later on. So as a best practice, I tell my clients, don't worry about commercial invoice or debit note. Everything you do, just issue a tax invoice. It's actually streamlining your work. It's streamline your work so that you don't issue 2 invoices for the same transaction and create more paperwork. Okay, so this is something to bear in mind. Now let's look at the case study here. Lux Furnishings. It imports and sells high-value furniture in Singapore and ship it to customers in Malaysia. And recently they have started providing ID services, interior design. So can you identify, based on these 4 lines, what are standard scope supply, what are the standard rate supply, what are the zero rated supply? Okay, so let's talk about this. So Lux Furnishing imports. So Lux Furnishing LF imports the furniture in Singapore. So there's already a standard rated supply, isn't it? Because import of goods has Singapore GST implication. So you need to look at that. You need to ask, who is the importer? Do not assume that Lux Furnishing is importing the goods, it is the importer. Because in the real world, again, it could be other people who are the agents of Lush Furnishings who import the goods into Singapore. So even though you might say, hey, you know, here, Lush Furnishing import, oh, sorry, wrong. Let me just do it again. Okay, Lush Furnishing imports the furniture in Singapore. I will not take it as, okay, Lush Furnishing is the importer. In the real world, I'll ask, okay, so who exactly is the importer? Okay, who is the importer? So bear that in mind. And then Lush Furnishing sells high furniture in Singapore. Okay, so the goods are here, it sells to a buyer in Singapore. So is that standard rate supply? You may say yes, because the sales takes place in Singapore. Remember in the earlier part of the presentation, I said no, it's not about the sales. It's not about whether the buyers and the sellers are in Singapore. It is about where the title to the goods passes. Remember, this is how GST works. Never use an income tax concept. Never use an income tax concept to apply to a GST situation. If the legal title to the goods, to the high-end furniture passes in Singapore, it is a standard rated supply. This is the reason. Okay? Understand? Thank you. Okay, so then recently they have started providing interior design services. So just now the furniture is a supply of goods. And now we talk about supply of services. So then whatever we discuss in this flip chart, we need to remove, because it applies, when it comes to services, there's another set of place of supply rules we need to know. So the question is that, okay, they start providing ID services. So if LF is based in Singapore, whether they provide services to a local customer or to an overseas customer, the starting point is that because LF belongs in Singapore, it's actually 9%. Now, to the lake where the buyers or where the service recipient is outside Singapore, then we need to ask whether under 21.3, the international services provision, we can find a particular paragraph that can help this situation to make it a zero rated supply. Okay, there's a provision called the services rendered to overseas persons. Okay, that falls under section 21.3J and section 21.3K. Now I'm not going into detail, but just take note. These two provisions applied to services rendered to overseas persons, and there are conditions that you need to satisfy. Okay, so if the condition can be satisfied, then this will be zero rated supply. If not, then guess what? It is actually a standard rated supply. Okay, so you have dealt with the place of supply. You see that it's not hard to apply the rules once you master the foundation. And this is what we do in real life. This is just what we do to answer clients' question. Draw down or actually write down the question, understand the facts, and create a diagram or picture using the basic principle I covered in the previous slides, and answer the question directly. It's like we answer exam question in real life, if you like it. Okay, the time of supply rule. So again, the time of supply rule is about the basic taxation point, which is whether I receive the payment in advance or I issue the invoice. Whichever the case might be, then that is the time of supply rule. So it's not pretty difficult to understand, but just take note again, it's not about the tax invoice being issued. It is an invoice being issued. So again, an invoice could be a commercial invoice or a debit note. All right. Okay, so let's move on to the next topic. Let's quickly talk about what is out of scope transaction. Now, out of scope transaction, let's talk about what is it. An out of scope transaction, if you go back to what I said in the previous place of supply rule, so I just draw these two again. One is called place of supply of goods, place of supply of services. Okay, so out of scope supply. Important point for goods, a recap, is where the legal title to the goods passes outside Singapore. Okay, so whether the buyers and sellers are in Singapore or buyers and sellers are overseas, I don't care. I just need to know whether the legal titles to the goods passes outside Singapore. And what is the significance of that? It means it's not a taxable supply, it's not a zero rated supply, it's not even an exempt supply. What is that? It's called out of scope supply, which means that it is a supply that is outside the scope of the Singapore GST. I'm not charging zero rate. I'm actually not applying GST to this transaction, so to speak. Okay, so that is the significance. Again, you need to report the right amount in the right boxes of the GST return. For services, how do I know it's out of scope supply? Well, I've got a provider outside Singapore, and then I've got a recipient outside Singapore. Again, does it matter where the recipient is outside Singapore or not? Actually, it doesn't, because the question is that is the provider belonging in Singapore? So here, the provider is not belonging in Singapore. So if this is the supply made to an overseas recipient, it is an out of scope supply. Okay? And then if the supply happens to be made to a recipient in Singapore, then this is a question of what we call, it is, first of all, remember the flip charges now, it is import of services. Okay? And then I have to ask whether the recipient is GST registered or not GST registered. Because if it is GST registered, the only thing that I need to worry about in this case is whether reverse charge applies. Because when the recipient is a GST registered person, this is in GST term a B2B supply of service. And then if the recipient is subject to reverse charge, then it's nothing to do with the provider here. It is the responsibility of the recipient who is running a reverse charge business to charge its own on its own the output tax. If the recipient is not a GST registered person, then indeed you may say this out of scope supply to start with. Depends on the value of the services rendered and other conditions. The provider may be required to register for Singapore GST, which is what we call under the B2C supply of services. And that's why right now it is a bit messy when it comes to supply of services, because I need to know the RC, I need to know the B2C supply of services, whether it is a digital supply of service or remote service. That all these things are now pretty important to understand. Okay, so the other thing is these categories of out of scope supply. What are the categories? Well, it could be a service that happens outside Singapore. Oh, sorry. I say again. I draw on the right thing. The wrong chart. It could be a service rendered by a service provider that doesn't belong in Singapore. Okay, it could well be seller and buyers both outside Singapore have the goods where the legal title passes outside Singapore, or just now, like I said, you could have a supply. You could have a supply made by a local supplier and a buyer, where the goods are transferred, where the legal titles to the goods passes outside Singapore. Okay, so this is what we call the out of scope supply. And another one that may come up is what we call private transaction. So let me explain a bit of the private transaction here. So private transactions are actually a supply made by the supplier, not in a business capacity. Okay, it could be one, supply of free gifts to customers, or supply of free gifts to the company's, to the supplier's staff. So this is what we call private transaction. Okay, it has nothing to do with the supplier's business. Okay, so in income tax term, you might say, oh, this is not for income producing activity. It's not for income producing activity. I mean, if you're familiar with the concept there. Okay, so supplier make a supply not in its business capacity, which is a private transaction, is also an out of scope supply. Okay, so just take note. And then I think I've covered all this already, so I'll move on to a case. So Global Consultants Private Limited. So I hope that you are okay so far. I may be speaking a bit fast, because there's one thing you need to know: if I speak very slow, you will fall asleep. Okay, so I speak fast for a particular reason. Okay, so here we have one case study, Global Consulting. or consultants. It provides business advisory service from Singapore to clients around the world. Their new contracts involve consulting services for a client based in Indonesia, where all activities occur. So for this purpose, they are rendering a service. Okay, so therefore we apply the place of supply rules of service to start with. Okay, and then GC is from Singapore. It renders a service to a client based in Indonesia. Okay, so if you have been following me about the discussion of place of supply, first of all, is there an out of scope transaction? Now, if you say yes, then I'm a bit worried. Please rewind the recording to look at how the place of supply rule for services should be applied. Number one, it is not an out of scope supply because the provider GC is actually belonging in Singapore. It could well be a service rendered to overseas person. But from a GST perspective, we have to say that the supply is actually a standard rated supply to start with, which means that it's 9%. Yes, all activities occur outside, the services are rendered outside, so what? For purposes of GST, it is not an out of scope supply. Okay? So then the next question is that, hey, how would GC be able to zero rate the supply under section 21.3 again? So for the purpose of this transaction, it looks like 21.3J will be applied. So go and take a look at what 21.3J is about. And then if the conditions under 21.3J are applicable, then the service would be zero rated. Okay, because it is a supply made by GC as a provider in Singapore, but the recipient is actually an overseas person. So 21.3J and another one is 21.3K are dealing with the situations where supply of services are made to overseas persons. Okay, so therefore it is not a out of scope supply. If you get it wrong, you need to rewind the video or study your materials carefully, because that unfortunately will give you the wrong answer. Okay, if you do not go through the materials properly. The significance of classifying the supply properly, or the flip side, misclassification. Obviously, you can tell if you classify the services in the wrong box. That's number one, incorrect return. There's a wrong filing of the GST return. Okay, you may say, but what's the big deal? Since I'm not charging GST at 0%, I'm not charging GST at 9%, right? The IRA's inland revenue does not suffer from any shortfall of tax revenue collection. Well, on that note, from a cash flow perspective, I agree with you. The other problem is this. I mean, in other parts of the video, you might need to ask yourself, what is the misclassification of, let's suppose, a zero rated supply to out of scope supply? You might say, oh, if I've been classifying all these services as out of scope supply, and if the value of the services exceed $1 million annually, it's not just about it's not wrong filing. It depends on whether GC has already been registered. That may trigger something called a registration issue. If let's suppose GC is not GST registered yet, and by thinking that all these services are rendered to overseas clients that are not taxable supplies, GC may have missed the registration requirement also, because the threshold in Singapore GST registration is $1 million annually on the value of taxable supply, and zero rated supply is taxable supply. You might say, oh, I don't need to apply, right? No, you have to. You can ask for GST return or GST registration exemption. I mean, if you study your material, you may see somewhere, this is called F2 exemption. So if you do make substantial amount of zero rated supply, in fact, it's above 90%, if I'm not wrong, you can apply for GST registration exemption under F2. but it doesn't mean you don't need to register. You do not need to notify control of GST. You have to. Okay, so that is the significance of this transaction. So you can see GST is pretty fluent, right? You can talk about scope of GST, the place of supply rules. Suddenly I can go to filing of the GST return. Somehow I may even go to the registration. Depends on the facts of the case, right? So a lot of these things can be applied because of a particular set of the facts here. Okay, so let's talk about third-party sales, and I still have 2 more sessions to go. So what is a third party? What is also not third party sales, third country sales? What's a third country sales? A third country sales is actually, this is a part of goods, right? So it is about shipment from a foreign country, okay? A foreign country such as here, country A. So what happens is that it could be a third country sale means that a sales that is made outside of Singapore in this case, okay? And the funny thing is this, third country sale is actually nothing to do with Singapore. So this is actually a direct foreign sale. But what is the significance of that? The significance of that is, remember the place of supply rule I said. So you can see that I've been talking about place of supply rule again and again. Although the sales takes place overseas where the seller and buyers are overseas, remember this. It doesn't mean that this is an out of scope supply. You got to ask the question, where does the legal title to the goods pass? Where does the legal title to the goods pass? Is it passing in Singapore or not? If it does, you may say this is a third country sales. But guess what? It is subject to GST. Then the problem of this third country sale is as follows. Okay, so let's talk about the GST implication. So let me just bring this over. Okay, so I just bring the image over, copy, I bring it over, I talk about the GST implication. I have personally been involved in that situation whereby it is a third country sales. So A is actually United States. And what happened was that you have got a buyer from US and a seller from US. So can you imagine? Will they even talk about Singapore GST? This is a sales between 2 American companies. Like, how on earth would you imagine they talk about Singapore GST? Okay, so what happened was that the buyer, in negotiating these sales, simply told the seller, my client, hey, I promise you that the goods which are currently in Singapore in the seller's warehouse will be exported. I have somebody coming to the warehouse to pick up the goods. Trust me, all goods will be exported. So from my client's information, I knew that this was an exchange of conversation through emails. Yeah, that case happened many years ago, so right now it should have happened because most people have been educated properly. But that was like, back then, I think it's about 17 years ago, 16, 17 years ago. So the buyer actually sent the seller 3 emails saying that the goods will be exported. And well, my client, the seller, actually followed the emails word for word and said, okay, let's do it. Well, if you understand the rules, the title to the goods passes in Singapore, which is what happened in that case. And then obviously, the seller did not account for any GST to the buyer to start with. And the value of these goods that are exported outside Singapore is more than 1 million. And you can imagine, because this US company is not GST registered, not only there is a liability to register, you may say, but a foreign company, does a foreign company have to register for Singapore GST? You bet. A foreign company may be required to register if it makes taxable supply that hits the threshold. Okay? And not only the registration is an issue, eventually IRS asks the seller to account for all supplies based on then the 7% standard rate. And that is not the end of the story. Not only turned all the so-called export of goods from a zero rate supply to a standard rate supply because of the registration issue, because of the shortfall of the revenue collection, there's also penalty. So how many of you now see that a third country sale, you may think there's no GST issue, could be quite interesting. Again, it's just because the place of supply rules we have is different from other countries. Okay, so I've just shown you a real world application. Okay, so I hope you enjoyed that. I hope you will not be this client in your life. All right, so I'm going through the TOGC, and then quickly I'll finish it because I know that it's already like about an hour or so of the video. It might be a bit long, but I feel that it's important for me to explain all these concepts. Okay, transfer of going concern. What is transfer of going concern? It is actually under GST add and excluded supply. Okay, now what is an excluded supply? Excluded supply is actually a supply that is excluded from being a standard rated supply. Oh, sorry, let me say it again. An excluded supply is a supply that is being excluded from being a taxable supply. So if you don't understand what I'm talking about, excluded supply, the effect of that is like out of scope supply, and that's it. Okay, even though you might say that it is a standard rate supply, nothing wrong with the idea, but because it's excluded from being a taxable supply, it is like an OOS or out of scope supply. When would that happen? Why do we have to even talk about this? It happens because it could be a case whereby a seller in Singapore sells a business to a buyer. So this is happening when you have a transfer of a business, not necessarily transfer of shares of a company. Okay, the seller is transferring the business to the buyer. And therefore, if you go to IRA's e-tax guide or your materials, you might be able to find the qualifying criteria. So for the purpose of this video, I'm not going to repeat all these criteria. Okay, the key thing is this. The key thing is that once the seller apply TOGC, as a matter of law, it is an excluded supply. The seller cannot charge GST to the buyer. Now, this is my position. My position is that because the characterization of the supply as an excluded supply, even though the seller is GST registered, is not allowed to charge. Some advisors may tell you the seller need not charge or should not charge or is not required to charge. Okay, my position as it is an excluded supply, is not allowed to charge. It's not about it should not charge or what. Okay, it is not allowed. And I've seen even some funny thing about some practitioners. They actually ask the seller to go to apply for advanced tax ruling. I've seen that before. And funny thing is that advanced tax ruling is based on the facts of the case. What do you think as a tax authority they will say to you? They will say that this is subject to TOGC provisions. If based on the facts of the case, you satisfy all the conditions. So the funny thing is that IRAS, even though you ask them for advanced tax ruling, they cannot give it to you because it's all based on the facts of the case. So the criteria is like check the box. Can you check all the boxes to argue that it is a TOGC? But one of the key things about TOGC I've seen in my life is that one of the requirements is that the buyer has to be GST registered. So many years ago, I had a case whereby I was acting for the seller. So they may ask, as I'm acting for the seller, why do I care whether the buyer is GST registered or not? But just remember, one of the criteria is that the GST, the buyer has to be GST registered. So then, at that time, it's like many years ago, it's not like now you can go to IRA's website to check whether whether any person is GST registered or has been deregistered. Like long time ago, there was no such facilities. So I have to ring the lawyer acting for the buyer and check whether it's GST registered. And guess what? The lawyer said, no, the buyer is not GST registered yet. And you know, it is just a few days before the transfer takes place or took place. So I quickly put on hold of the whole transaction, put on hold the entire transaction because I couldn't satisfy this condition. So then, luckily, I put on hold the entire transaction, and we asked the buyer's lawyer to make sure that you put it under GST registration. Only then we effect the transfer so that we can apply TOGC properly. Okay, luckily, well, I managed to put it back, put it on hold, or else I'm actually giving wrong advice to the seller. Okay, so without further ado, let me just go through some of the case studies here. I'm going to spend the next quick 10 minutes to go through the case study and see whether you can relate to what we have said earlier on. So number one is a local business sales. XYZ is a family-owned electronics store in Singapore. So XYZ is in Singapore. Okay, so we can see, and as any time when you are studying the facts of the case, I highly recommend that you put a diagram next to the question so that you can see the diagram or see the flow of the transaction. Okay, so the XYZ is a family-owned electronics store in Singapore. Is being sold to DF as a competitor. Okay, so assuming that DF is also from Singapore, and then this includes, what is included in the sales is stores, premises, stock, and customer contracts. So evaluate whether the sales qualifies as a TOGC. So first of all, it is a local sales of the business. It is a transfer of business. Okay. So we need to go through the guideline, we need to go through the criteria to make sure that the transfer of going concern provision can be satisfied. Okay? And then what happened is that one of the conditions that I mentioned in my sharing of the case study is that DEF has to be GST registered. If DEF is not GST registered or is not registered for GST eventually, this is not a TOGC. It means that XYZ will have to charge, if it is registered for GST, it has to charge the value of the business and account for the output tax to IRAS. And if DEF is registered for GST, well, you can claim it back. Okay, so this is not ABC retail. It's actually XYZ retail and DF electronics. So sorry for the typo. So it's very important to understand how I apply for TOGC and the conditions, and then understand if TOGC applies, what will happen to both parties. And if TOGC cannot be applied, what will happen? So most people, most of the time, how TOGC was serviced is because the seller might say, I have to charge you 9%. And DF will say, wow, I'm buying your business, can you give me a discount? And then the discount comes up with the discussion of whether you should charge me the 9% or not. Okay, and that's how this discussion of TOGC service most of the time, from my experience. Okay, so next one is exporting goods overseas. So this DEF Technology, Singapore-based company. Okay, you can see again I'm doing this. It manufactures computer components, export to a distributor in Germany. So this is export, right? So what is the GST implication? Number one, this is goods. Place of supply of goods says what? It is a standard rated supply. Why? Because it's export. The goods are originally here. It's moved to Germany. It is potentially subject to zero rating only if the export documentation requirement is satisfied. So what conditions or what documentation is the export documentation requirement? Again, you will need to, as a matter of practice, go to the export guides to find out what IRAS requires. And from a case that happened 2 years ago called the board review case called GDY and control of GST, and now it became a high court case called Dynamic Enterprise. In that case, it was said that if, let's say, the conditions of the export documentation requirement cannot be met because of the unique circumstance of your company, you will still need to obtain a specific direction from control of GST to waive or vary the conditions that were put under the export guide. Once you obtain the specific direction, the direction will be bound by the control of GST. So one of the common mistakes I've seen in the marketplace is that the client said, well, my business is very unique. I cannot satisfy these conditions imposed under the export guide, so I'm not going to follow it. No, you cannot. This is what we call a blind check the box. If you cannot satisfy, the supply is automatically standard rated. So if you can't satisfy the condition, it is important to let IRAS know and get control of GST to issue a specific direction to waive or vary the condition so that you can still argue that it's zero rated. Okay, so that is the significance of this case. Okay, the third one is providing digital services to overseas clients. So this is digital services. Okay, so place of supply rules for services. So GHI Media is a digital marketing agency in Singapore. It provides online advertising services to clients based in Australia. So can you standard rate the supply? Now this requires you to start with the fundamental principles. GHI is belonging in Singapore, so it is a standard rated supply to start with. This is a service rendered to an overseas person. So earlier on, you might think section 21(3)(j) applies. Yes, indeed you can. But because if this is advertising, okay, there's another provision called 21(3)(c) that might be directly applicable. So you may need to look at both. The answer to this question boils down to whether the supplier, if you are talking about 21(3)(c), then you need to know that there are some changes to the application of 21(3)(c) 2 years ago. They look at where the customers belonged. If the customer does not belong in Singapore, then this is actually a zero rated supply. This is for online advertising. For advertising services. But if you are just talking about typical online digital marketing services, we do not apply 21(3)(c), or is not about advertising. You would then look at 21(3)(j) and look at the condition to decide whether you can zero rate the supply. Again, I'm not going to give you exact analysis, but just to show you the methodology that I applied to solve this case. I have to say that I do not remember everything. No practitioners on GST remembers everything. So you need to remember the framework or the methodology to solve the problem, and then you go and check the law to make sure that the law can support your conclusion. Okay, so case study 4 is purchasing goods for business use from overseas. So then it is a case JKL is from Singapore. He imports luxury fabric from Italy. So we can say that this is an import. So remember in earlier discussion I said import of goods. Who is the one importing the goods? If JKL happens to be the importer, then the understanding is that it has to pay import GST to Singapore Custom before it's allowed to remove the goods from the custom territory. And then if JKL is GST registered and it's because the goods are for business use, it should be able to claim back the import's GST as an input tax credit. Okay, it should be. And this is how it works. All right. So last one, case study number 5, selling a business as a going concern. So going concern is a concept that is very well known by all the accountants. It's like a business that can permanently be carried on. So this suggests that it's like TOGC thing, right? If you look at this. M&O Services is a cleaning service provider. It decides to sell its entire business, including contract equipment, to PQR. So M&O sells to PQR. Again, this is whole business. So it looks like a TOGC case. So again, the question is to look at the conditions of TOGC and check out the boxes, one of which is whether PQR is GST registered. Okay, once you have determined all boxes are satisfied, then the conclusion is that M&O will treat that as an excluded supply. Hence, it is not allowed to charge any GST output tax to PQR. Okay? And of course, part of the TOGC also talks about the record keeping requirement, because IRAS may come back and ask you to supply the record. One of the key things is because in this case, M&O is going to sell the entire business. So obviously, M&O will disappear. Some people, when I first learned TOGC many years ago, I thought, oh, but that means the business is gone. Would TOGC be satisfied? It's a wrong question to ask. It's a question of whether PQR, as a result of taking over the business from M&O, will carry on that business of M&O in its company. So it's nothing much about M&O being disappeared. It's okay. The condition says whether PQR will carry on M&O's business after the transfer. That is actually the question you need to address. Okay? So with that, let's summarize some of key lessons here. So as a recap, we talk about the scope of GST in Singapore. Okay, we talk about serial supply, we talk about standard rate supply, out of scope supply, third country sales, TOGC. Okay, we talk about what is actually out of scope supply. It is therefore important for you to master the true diagram, the place of supply for goods and place of supply for services. And I believe it is actually useful and beneficial for you as part of your study to master these two diagrams, or I call it flip chart in my own training. Okay, and then we talk about the significance of third country sales and transfer of going concern for Singapore GST purposes. You remember, I've given you some case studies to show you not the answer. Here is one thing I need to really stress. Like you may say, hey, why am I not providing any answer? Because in the real world, there's no such thing called model answer. If there's model answer, I don't think we are there. We are still in the practice. Because you can just refer to the Bible and you can look for the answer. What you need more is your methodology to understand how to solve GST problems. To me, that is more important than the answer. Okay, there's no model answer in the real world. All right, so I'll show you through case studies how I solved GST problems through drawing the diagram, putting the parties in the right place, apply the general rules or the principles. That is it. And that is how I prepare GST advice in real life, by the way. Okay, so hope you understand. So these are the key takeaway. The best practice is not to remember this. The best practice is to understand the principles, draw a diagram, know where the parties are, ask what exactly is the transaction about, and apply the rules. And then you derive the answer based on your analysis. And that to me is how GST practice should be in the real world. Okay, so with that, thank you very much for watching. And I hope you learned a lot from my experience on this topic, understanding the scope of Singapore GST. So hope to see you in another video. Meanwhile, take care and all good wishes.